Thank you everyone for coming to this SaMMF lecture. This will be a lecture by Marzena Rostek from University of Wisconsin-Madison, and the lecture is Decentralized Market Design, Advanced and Open Questions. For those who follow the literature, you know that Marzena is one of the big players on market design, and we are very pleased to have her here giving this lecture. Thank you, Marzena. You can take over.
Thank you for having me, and thank you for organizing this lecture series. It is a truly terrific resource, and I mean for all of us. I'm very excited to be part of it. I would like to use this opportunity to talk about recent developments in financial market design. So this is a literature in which I myself participated, but I would like to cover recent advances a bit more broadly. Can you see my slides moving? Yeah, all right. Arguably, one of the most salient development in financial market research in recent years has been all the work on financial market design, motivated by new data and new questions concerning market fragmentation and imperfect competition. We see parallel developments for other industries. Data on market concentration and spatial data on market fragmentation continues to be reported for virtually every sector of the economy. Production, labor markets, international trade, monetary policy, and other markets which have traditionally been analyzed using competitive models of markets which are centralized in some sense. For financial markets, we've known at least since the mid-1980s, this is when individual trade level data became available, that the presence of large institutional investors is significant in the industry in terms of trading volume, as well as the ability to innovate and access information. We know that institutional investors routinely estimate their price impact using market impact models. These are statistical software packages. We know that the trading costs associated with price impact continue to dominate all of the explicit trading costs, including commission fees, order processing fees, and brokerage fees. A bit more recently, new data, particularly the data coming out of the financial crisis, has highlighted the extent to which trading is fragmented or decentralized. And so essentially, all financial assets are traded in a variety of coexisting trading venues of various kinds, and often for the same traders and assets. It will be impossible in this lecture to give justice to all of the ways in which market fragmentation matters. But let me just say that in the past couple of decades, the number of alternative trading venues outside of traditional open exchanges has increased several-fold. And new types of electronic marketplaces have emerged, which offer different types of market clearing. For instance, a direct matching to an intermediary, trading in a dealer network, or an open exchange but online to different types of investors, institutional, retail, and intermediaries. Now, to be sure, what's novel about these electronic marketplaces is not the availability of alternative trading arrangements to different types of traders. Goldman Sachs has always had a trading desk for large institutional investors. We used to call these markets upstairs markets. What these electronic markets have brought are new technologies, new frequencies, new technologies to clear assets, and the use of artificial intelligence. In this talk, I will slightly conflate imperfect competition with market fragmentation. And this is because in a decentralized market locally, in the relationships in which traders participate, they are not negligible. They are large, regardless of the number of market participants. Right? So the fact that market power and market fragmentation are receiving renewed attention in the literature around the same time is not really coincidental. And there is a lot of interest right now in understanding the effects of imperfect competition and market fragmentation. And so the literature isn't quite fully integrated just yet. The literature on market power and market fragmentation isn't quite fully integrated. But we do recognize that the assumption that trading is centralized, that is, that a single market clearing applies to all traders and all assets, is a good description of an auction, but not a market, not for most industries. We also recognize that even though in many markets there are, the number of participants is quite large, most of the economic activity is due to a small group of large traders. It's our understanding of the extent of market concentration is improving dramatically with new data sets. Just a couple of weeks ago, a new study came out on the Bitcoin market. You may have seen it. It was featured in the New York Times. The study reported that in the first couple of years of the existence of the Bitcoin market, most of the action was in the hands of 64 miners. And that number includes the founders of this market. Well, in any case, you might ask, what's the nature of the effort here? The effort towards building these more realistic models of fragmented markets with large traders who recognize their price impact, right? Is it primarily computational? We know that incorporating strategic behavior, private information, or even trader heterogeneity is hard enough in centralized market models, especially if we care about the dynamics, right? So with market fragmentation, all these challenges scale up. But perhaps with some advanced algebra, we'll get the results we need. Well, in this talk, in this lecture, I would like to underscore 3 points. As I see, decentralized market design will be a different kind of theory compared to the theory of centralized market design. It will challenge the methods we've used and also how much has already been done. Okay, so where does the equilibrium theory of imperfect and competitive fragmented markets stand? Let's take a closer look. Well, research on strategic behavior in financial markets per se has a long tradition, right? The literature on various problems concerning private information has advanced through partial equilibrium models. But until quite recently, the equilibrium of the market as a whole and asset pricing have been studied and taught using competitive models of markets which are centralized, in which information is symmetric. That is, there is possibly some randomness, but no private information. Similarly, the literature on decentralized trading is very active right now. And so many people associated with the search and matching series have contributed to our thinking. Also for markets other than financial. But it's useful to keep in mind that the effort to build rich, flexible models of decentralized financial markets really took off only in the mid-2000s. Since then, various models have been proposed, which roughly speaking or mathematically speaking can be grouped into models based on random graphs or fixed graphs. There isn't a canonical model of decentralized trading just yet. It is unclear there should be one, given what the data is telling us about the richness of market structures and market designs out there. Still, broadly speaking, there are at least 2 classes of models through which the literature on financial market design, centralized or decentralized, has developed. One is based on the limit order book, which has been popular in markets in which bidders have unit demands and supplies. Another class of models for markets with large traders who have multi-unit demands, decreasing marginal utilities or marginal costs, which thus allows for an explicit treatment of price impact, is based on uniform price double auctions in which traders submit price contingent demand and supply schedules. All right, that class is the finite market counterpart of the standard competitive model, including the general equilibrium model, which is also based on the uniform price and multi-unit demands. Now we can see that a lot is happening in this literature right now. Still, most of what we understand about equilibrium with large traders has been established in a variant of a quadratic Gaussian setting. Okay, so all traders' objectives are quadratic, all random variables are jointly normally distributed. Now, even in this, a useful perspective might be that even competitive models with heterogeneous traders are typically analyzed using numerical methods, often heavy computational methods, and often relying on a quadratic approximation. So with an additional fixed point due to strategic behavior and private information, we shouldn't really expect to rely on fully analytic results for general payoff functions going forward. Now, even in the quadratic setting, advances such as incorporating trader heterogeneity, allowing for flexible market structures and general information structures have occurred only in the past decade. Okay. Nonetheless, these advances have led to a common analytic framework for static, dynamic, centralized and decentralized markets, which one can further expand by incorporating the relevant details of market design or market structure. All right, let me make a few comments here. So the limit order book models have tended to be more popular in models of decentralized markets based on random search, right, and bilateral transactions. Double auction models have tended to be more popular in markets in which trading relationships are fixed rather than random and can be bilateral or take place through exchanges, private or public. The second class is where I've had an opportunity to contribute with various wonderful co-authors. So I'll try to focus on that class, even if to complement the other lectures in the series, which were about random search. But I will try to focus on questions and ideas rather than models. Okay, but in hindsight, what enabled this systematic approach, a common analytic framework for static, dynamic, centralized, and decentralized markets, which might comprise multiple venues, possibly for different traders and assets, and possibly characterized by very different details of market design? Well, it was the following result. It turns out if we look at the equilibrium conditions in any market structure based on these uniform priceable auctions, the equilibrium fixed point in traders' demand and supply schedules is equivalent to a fixed point in traders' price impact matrices once the problem is written in matrix form. How might that be possible? And does this result have any economic interpretation? Well, think of an individual optimization problem of a trader in an imperfectly competitive market. All right, the key decision of the trader concerns how much to reduce the quantity demanded or supplied in response to price impact, relative to what the competitive demand and supply would be. It turns out that the trader's price impact, which is an endogenous variable, it depends on the behavior of other market participants, is the sufficient statistic for the decision. Right? So hence the possibility for the equivalence. Now, of course, in more complex market structures, price impact is a more complex object. There is a within exchange and a cross exchange price impact. In dynamic models, there is a within round and intertemporal price impact, but its equivalence carries over. And it actually does have a compelling economic interpretation based on the logic of individual optimization, which maps into market practice. Institutional investors routinely estimate their price impacts using market impact models, taking as given the residual supply, which they treat as a payoff relevant sufficient statistic for the residual market against which they trade. So that's the idea here, to transform these individual optimization problems into a fixed point. Now, this equivalence result not only makes the analysis much more tractable, it reduces the dimensionality of the problem and the computational burden. It eliminates the need to characterize the distributions of endogenous variables, of equilibrium variables, once we have the fundamentals and the equilibrium price impacts. We have these distributions. But perhaps more importantly, some of the most pressing questions in the literature right now concern decentralized market effects, which have no centralized market counterparts, and the role of market power. Since that framework directly nests the standard centralized market model, it can facilitate the identification of these effects. Now, these two classes of models based on random graphs and fixed graphs represent somewhat extreme views of the market. And there is scope for integrating these ideas and techniques. And there are a few reasons why doing so would be worthwhile. First of all, for many markets, a realistic description would neither impose that the probability that two counterparties who trade at day T meet again in the future is almost surely zero, nor that the trading relationships are fixed. Okay, so what I'm really trying to get at is the endogeneity of the market structure, a problem I'll go back to later. Second, random matching models capture markets in which fragmentation is inherently dynamic in the following sense. In the random matching model, the impact of market fragmentation on the trader's first order condition arises only in a dynamic counterfactual in anticipation of future trade following a trade breakdown today. Okay, hence also the view of the impact of shocks or information aggregation as a diffusion in this literature. When we characterize equilibrium in random matching models, we characterize dynamic equilibrium. Now, the second class of models describes markets in which market fragmentation matters in a cross-section, even if trade is static in markets with multiple venues, as well as in the time series, and these effects can be separated. Third, just as the classical equilibrium theory assumes that there is a single exchange for all traders and all assets, i.e. the centralized market assumption, the opposite assumption is suitable for over-the-counter markets. Most transactions are bilateral. Now, in other markets, for instance, equity markets, now bond markets, traders can also participate in exchanges, private or public. And these multilateral relationships cannot be represented as graphs without loss, right? So sometimes it is possible to identify an exchange with a complete graph. We have all-to-all trading. But in general, equilibria and complete graphs differ from those in which agents could interact as a group, as they would in an exchange. So really, we really need to model these multilateral relationships. And going forward, we will want to account for an increasingly diverse set of trading venues, right, which builds on these two classes of models. So just to give a concrete example, let's look at the assets listed on the New York Stock Exchange. We are talking about some of the most transparent liquid assets. So today, less than 25% of the trading volume of these assets is executed on NYSE. The remaining volume is created in 15 other public exchanges. So there are 16 public exchanges in the US today. And or public means that basically all traders can participate there. Over 30 private exchanges, so think of dark pools, liquidity pools, where participation is restricted mostly to large institutional investors, and over 200 dealer networks. Right? I'm essentially giving you a complete description of the top of the equity markets in the US today. But this is representative across asset classes, domestic, international, and so on. Now, by no means is this meant to be an exhaustive account of the literature, of the models in the literature, but these two classes of models have been developed a bit more broadly. Right, so next I would like to talk a little bit about how the focus in terms of questions has evolved in the literature, and why decentralized market theory will be different. It will be hard to overstate the importance of market power and market fragmentation for theory, design, or policy. Market structure and the incentives of large traders have been implicit or explicit in virtually every policy debate in recent memory. The mandate to move assets traditionally traded over the counter to centralized platform, the difficulty in standardizing these assets to make them suitable for centralized clearing, the incentives of large traders to manipulate benchmark indices, the difficulty in designing privacy-preserving mechanisms, the value of pre-trade and post-trade transparency, new technologies, new market clearing arrangements, and most recently, the weaknesses in the design of treasury auctions exposed by the unprecedented disruptions during the pandemic, and the proposal of the chair of the Security and Exchange Commission 2 weeks ago to eliminate intermediaries between trading platforms and retail investors. These debates are far from settled and themselves indicate opportunities to contribute, but also a sense of urgency. Okay, so let's keep in mind that the first generation of models which developed when some of these questions came to light was based, as dictated by tractability, on a continuum of traders who are small relative to the market, often for the particular market structure, one asset, and symmetric information. Hence also the view of market fragmentation as a friction that takes away from efficiency in this early literature. Indeed, in the policy discussion, there's still often a presumption that centralized trading is beneficial, at least for the investors. So one of the contributions of this literature so far has been to qualify that presumption. And these views have evolved. We now understand that a fragmented market can be more efficient, can improve the distribution of risk in some sense, can help us simplify the design for market participants, and be more stable. Now let's be careful here, right? As a matter of theory, the observation that when traders are large, a fragmented market can be more efficient should not really be surprising. The key question is, and has always been, can we develop any results, general results that can guide the design, regulation, and shed light on the need for financial market antitrust? And as I see it, that's where some of the potentially most impactful opportunities for research arise. We have a beautiful theory of design of centralized markets, auction design, which has been influential in theory and in practice. Developing the corresponding design principles for decentralized markets is very much work in progress. And these are the questions that keep me up at night. The path is not exactly straightforward, and that's because decentralized market theory is going to challenge the methods we've used. In order to appreciate that statement, it will be helpful to review some recent results about market fragmentation. But first, let's try to consider what exactly the centralized market assumption entails. Okay, so let's try to think for a moment. What do we assume when we take an off-the-shelf model of centralized trading? Well, the essence of centralized trading in the standard model is not centralized or decentralized implementation in the mechanism design sense, but rather that a single market clearing applies to all traders and all assets. Right? So in particular, two assumptions are implicit in the centralized market assumption. One is that trader participation is in the market is complete in the following sense. Each trader trades all assets with all other investors. Right? So naturally, this assumption has been relaxed by the large literature on decentralized trading based on random graphs, fixed graphs, and other models with limited participation that are not often associated with the decentralized market literature. But there is at least one other assumption implicit in the centralized market assumption. When trading as decentralized, we need to be explicit. We as modelers need to be explicit, or the market designer needs to be explicit, or a trading protocol needs to be explicit about the types of demand schedules allowed. Okay, so imagine that I'm participating in a market with 2 exchanges, each for one asset. Let's say the same asset. Should the demand I'm submitting in one exchange allow me to condition on the price from the other exchange as well? In other words, should I be submitting a fully contingent schedule, or two, with the quantity of each asset being a function of the price vector, or I should be submitting 2 uncontingent schedules, R2R, with the quantity of each asset being a function of the price of that asset alone? The standard multi-asset equilibrium model of financial markets, competitive or imperfectly competitive, on which asset pricing is based, assumes that schedules are contingent. We work with demands RK to RK in multi-asset models, which in practice represent cross-asset conditioning possibilities that exist in some but not too many trading protocols. More typically, an order placed for an asset cannot be made contingent on prices of other assets. If allowed, such cross-asset conditioning applies only to a limited number of assets. So we do see cross-asset conditioning in markets for spectrum, electricity, certain options in futures markets, a pair of rules called Reg NMS and unlisted trading privileges implemented in the US equity market more than a decade and a half ago, de facto implements contingent schedules. But we do not see analogous rules in markets for other asset classes or even the stock market abroad. Feasibility might provide one rationale for why cross-asset conditioning is not too prevalent. Right? As technology advances, electronic trading platforms actually experiment with and innovate in such orders. But why should we care? Why should we care about cross-asset conditioning? Well, let's take a closer look at how it matters. Okay, so imagine a market with I trade as K assets organized as K exchanges, each for one asset. Okay, suppose that all traders participate in all exchanges. So the participation in the market is complete, it is symmetric. All traders trade all assets. Okay, so the effects in models based on incomplete participation do not apply. But now traders submit uncontingent schedules. What is the significance of that? Well, the assumption of fully contingent schedules in the standard model requires that the demands and supplies of all traders for all assets must be aggregated jointly to even determine the vector of market clearing prices and trades. The assumption of fully contingent schedules requires joint clearing. Right? So part of what makes decentralized markets different is that assets clear independently rather than jointly in any given trading round. Implementing joint clearing will require coordination among market makers. I mean, possibly algorithmic market makers, but still, that's not quite feasible. Let me make an important remark here. So you might be wondering, well, I may not be able to condition my demand on for one asset on the price of another asset in the same round, but nobody can prohibit me from conditioning my demand on past prices for any asset in any exchange, as long as these prices are available. Okay, so does independence in market clearing really matter? Well, it does. The ability to condition my demand on past prices allows me to incorporate the information about shocks to liquidity or shocks to information that renew the gains from trade, right? Whether demands are contingent or uncontingent. The ability to condition my demand on the contemporaneously determined price of another asset in the same round matters for how current round shocks are incorporated in my demands. That's what independent clearing is about. These effects will be of first order in any round of a dynamic market. Well, you might still be a little skeptical and say, what if we can trade at high frequencies, right? What happens in a continuous time limit? Well, first of all, a large fraction of volume, even for equities, still occurs at lower frequencies, but let's focus on high frequency markets. In general, the significance of these effects will depend on the relative frequency of trading rounds and shocks to information or liquidity that renew gains from trade. But you can see that if the shocks to information are at least as frequent as trading rounds, these effects will be of first order in any round of a dynamic market and in the continuous time limit. All right, so we've now identified two assumptions that we make whenever we use centralized market models. There's more, but let's focus on the second one. The literature has analyzed in detail the implications of incomplete participation. Let's focus on the second assumption. How does the fact that asset markets do not clear jointly, but rather assets clear independently matter? How does it matter? Well, in a recent project, joint with Ji-hyun, who was at UCL, we show that decentralized trading, the fact that assets clear independently, gives rise to new financial products and new technologies, which would either be neutral or have no counterparts if trading were centralized. Okay. So what are these new products? Think of synthetic products, ETFs, ETPs, or derivatives, which will be redundant with contingent demands. In the standard equilibrium model of financial markets, competitive or imperfectly competitive. And the introduction of securities whose payoffs lie in the linear span of the traded assets is redundant. It does not change the trader's utilities. Asset diversification depends only on the asset span, but not the asset structure. Hence also numerous invariance results in the literature. In practice, other than for tax-related purposes, traders choose new products or new technologies, either to improve information, to hedge events they couldn't hedge before, or to improve liquidity, to lower their price impact. Regulators often classify derivatives markets as challenging, in part because of the difficulty in assessing the impact of new products and the scope for innovating them. Right? Once again, in the standard model, derivatives are redundant. Standard methods for derivative pricing, which are the basis for asset valuation, use one of the following two methods. One assumes the existence of a replicating portfolio. That is, it assumes that we can price new products to be introduced in markets using linear combinations of the prices of the assets that are already traded. That is, it assumes that these products are redundant. The other method endows a market with an exogenous demand for a derivative product. But if we want to understand which products will and which should be introduced in markets as a function of market characteristics, we need an equilibrium model of non-redundant derivatives. And once we acknowledge that it is not the case that all assets clear jointly, the otherwise standard model becomes such a framework. Derivatives are generally non-redundant, and they are payoff relevant because they change information and liquidity. Let me make sure it is clear what the exercise here is. Right? So some of you might be familiar with the results from early competitive theory, which tell us introducing assets outside the span of the traded assets won't be neutral, right? If there's a set of estates, the existing asset structure spans a subspace, introducing assets in the complement of that subspace will not be neutral. Naturally, these results will carry over to imperfectly competitive markets, but that's not what this is about. We are discussing the introduction of securities whose payoffs lie in the span of the traded assets. Now, a contract theorist or a game theorist or even a market theorist in the audience might say, independence market clearing introduces a form of contractual incompleteness or market incompleteness, if you will, right? So the fact that new products are non-redundant is rather expected. And this is an accurate statement. But the point here is that relaxing that assumption, and only this assumption, renders derivatives non-redundant in an otherwise standard framework. Even if all traders trade all assets and all derivatives, and there are no regulatory frictions which would only amplify these effects. Now, furthermore, the failure of spanning has other consequences, which I would like to talk about. But before we do it, we can now ask, what are the implications of these new products or technologies for welfare? Well, generally,
can I ask a quick clarifying question? Just a bit curious how general the result is. I mean, I could see for like any kind of generic structure of shocks or some underlying uncertainty, it would probably hold. But I mean, you could find special cases of shocks where it would be enough, the non-contingency would be enough.
If you take a standard model of asset pricing, assume that the amounts clear independently across assets rather than jointly, new products will be redundant if and only if the joint distribution of assets is either independent or assets are perfectly correlated. For all other joint distributions, some financial products will be non-redundant. That's how general it is. The redundancy result is non-generic as soon as we relax the assumption that assets clear jointly.
Okay, thanks.
Thank you.
Can I just
yes?
Yeah, like just clarify, like I have the intuition correct. So is it something that's going on is like I like coffee and milk. If the markets are cleared separately, I may, and I like in a specific proportion, then I have to bid it separately. And I may, depends on the shock today, get more milk than coffee or vice versa. So so by creating a product that sells my coffee and milk in the same proportion, I basically improve the allocation. Is that the intuition? Is like, and the only way that this will not happen is if my demand for coffee and milk were totally independent, or if this or were always perfectly correlated, so it would always get exactly the same proportion. Is that the intuition? What's going on?
I want to say yes. I want to say that this non-redundancy is totally unsurprising. I mean, as soon as we notice that whenever we use centralized market models, we make this implicit assumption that assets must clear jointly because we must determine the vector of prices simultaneously. We must be solving a system of equations simultaneously. This assumption has been in front of our eyes. It's just, we didn't pay attention. But as soon as we relax it, financial products are non-redundant, and it's not really surprising. What's important is figuring out which products should be traded. So I want to say yes. and to be sure, derivatives can lower welfare, right? Generally, new products may or may not be conducive to efficiency. Nonetheless, one can show that in markets with any traders and assets, so regardless of the primitives, one can always design financial products so that The market with multiple venues which clear the underlying assets and derivatives independently, as they do in practice, is at least as efficient as the centralized market, which clears the underlying jointly in which derivatives are redundant. Okay, so there are two results here. First, the centralized market gives a lower bound on welfare, gives a lower bound on what's possible in welfare terms. And second, we can do strictly better under general conditions. Okay, so not only is joint clearing unnecessary, because we can mimic it, but it can be strictly suboptimal. Why? Why can a market with multiple venues which clear independently be at least as efficient as the centralized market which clears all assets jointly? Why wouldn't platforms, trading platforms, let traders condition their demands on prices from other venues? Doing so can reduce or in fact eliminate the inference errors. Well, if the market were competitive, if traders were price takers, the contingent design, joint clearing of all assets would indeed be the most efficient market structure. But in markets with large traders, changes to market clearing also transform traders' price impact within and across exchanges. And it turns out that these changes to liquidity can countervail any information loss. Right, so that's the intuition in a nutshell. I would like to point to other implications of the fact that spanning goes out of the window. Let's suppose that synthetic products are not available, right, or not feasible. Pension funds are not allowed to trade certain types of derivatives. We can still design markets with multiple exchanges which clear independently to make sure that they are more efficient than the centralized market by letting providers innovate on trading technologies. Right, so there is a lot of interest in the industry right now in designing technologies for clearing multiple assets. Assets have traditionally traded and cleared independently. So these days, exchanges increasingly allow traders to condition their demands on the price, quantity, and other characteristics of other assets, much like in a contingent demand, in a contingent model, but I mean locally, not without allowing full contingency on all assets. So in a separate paper, we introduce a new market design problem, the design of market clearing in markets for multiple assets, which encompasses the standard in theory, less so in practice, contingent design, joint clearing of all assets, the uncontingent design, right? So independent clearing of all assets, and many more designs. Once we dispense with the assumption that all assets must clear jointly, the set of possibilities to clear assets is quite vast. And there are a number of questions we need to answer. As technology advances, is the efficient design going to rely on technology that clears all assets jointly? I'm sorry, separately, independently. Should we prioritize clearing of some assets? How to process prices, past prices across assets? Can it ever be optimal to delay disclosure or possibly withhold processing these prices altogether? Now, to be sure, these are the questions we need to answer for any trading round within any unit of time. They apply at the highest frequencies. Even at the highest frequencies, the volume of orders is so high that right now many providers are trying to come up with new ways to prioritize clearing across traders, right? The problem I'm talking about now is prioritizing clearing across assets, right? So it's complementary in a sense. Bottom line, once again, we can design market clearing to make sure that the market is at least as efficient as the standard centralized clearing, where these changes would all be redundant or not even well defined, as well as independent clearing. And once again, we can do strictly better. But there is a new question here that is more interesting. So as such, these new financial products and financial innovation has been exponentially increasing since the 70s and continues to be exponentially increasing if you look at the time series. And new technologies represent alternative ways to exploit the complementarities and susceptibilities in the trader payoffs, right? Which Bruno pointed out. I mean, my payoffs are interdependent across assets. My payoffs are not separable to affect liquidity and welfare. By letting traders, by allowing sophisticated preference expression in traders' demands, these new technologies are assuming the traditional role of securities in affecting liquidity and welfare. Right, so we could ask, can these new technologies reproduce the equilibrium effects of synthetic products for the same assets? Well, in fact, it seems that derivatives offer more degrees of freedom. We can choose the weights with which we bundle the asset payoffs. So it seems that a more appropriate question should be, can synthetic products substitute for the equivalent effects of these new technologies we are thinking about? And there are two results here. First, this is generally not possible. Neither instrument can mimic the effects of the other state by state. Either can dominate in welfare terms. So in general, new financial products and new technologies represent separate instruments in financial market design, and they should be regulated separately. One can also show that if we compare the effects of new products and technologies across distributions of traders' holdings, derivatives lead to a riskier distribution of payoffs. What does it mean? It means that a policy that cannot rely on detailed information about traders' holdings, sometimes this information is available, but if it's not, the policy might in fact favor innovation in technology. It is less risky. Well, these are some of the ways, some of the innovations that become available and payoff relevant when trading is decentralized. There is so much more to understand. But in this last part, I would like to focus on why a decentralized market is going to challenge the methods we've used. Right, to begin, it weakens the role of spanning and theorems which rely on it. Spanning is the foundation for asset pricing, the way we teach it, the way we apply it. The spanning methods are used in counterfactual policy analysis and asset valuation because they have provided us with a representation of uncertainty through the implied state space of which state contingent prices are defined. When spanning doesn't hold, and it fails as soon as we relax the assumption that all assets must clear jointly, these state contingent prices are unhelpful. Right, so what other methods could we use for policy evaluation? It is unlikely that in the study of decentralized markets, we will be able to rely on some decentralized market counterparts of state contingent pricing. And this is because when traders are large, the implied representation of risk, aggregate or idiosyncratic, depends not only on the fundamental risk in the market, but also on traders' price impacts, which are endogenous, and hence that representation is no longer invariant to changes to market structure or market design. So these methods will not work except under special assumptions. So what could we do? Well, we can certainly structurally estimate the first several conditions for static, dynamic, centralized, and decentralized market models with structural methods. We won't have to rely on any strong parametric assumptions. We can do it by extending the methods for structural estimation introduced by Ali Hortaxo at Chicago and Jakub Kassel at Princeton, who proposed methods for structural estimation of multi-unit auctions, right? So centralized markets with large traders. Isabelle Perrin and Quan Vong introduced methods for structural estimation of auctions in which bidders have unit demands and supply, so indivisible good auctions. Ari and Jakub introduced methods for multi-unit demands and divisible good auctions or markets, which fit asset markets well. What else could be done? Well, we could make use of that result that equilibrium fixed point is equivalent to a fixed point in price impacts, which applies to static, dynamic, centralized, and decentralized markets, and maps quite naturally into the demand system approach introduced recently by Ralph Cohen at Chicago and Moto Yogo at Princeton. In that approach, you estimate asset elasticities, which are essentially inverses of price impacts. As we are transitioning towards working with and teaching optimization methods through various models of decentralized markets, more gaps remain. Decentralized trading will also limit the scope for recursive and Markovian analysis of markets. Why? Modeling decentralized markets requires, by definition, that we relax various symmetry assumptions on traders' objectives, the market structure, the information structure, and so on. But heterogeneity makes recursive methods inapplicable in dynamic models of markets, at least with standard strategies used in markets. Right? So, and the reasons can be gleaned from the theory of dynamic oligopoly. In markets with heterogeneous traders, in dynamic markets with heterogeneous traders, price assigns asymmetric weights to traders' signals, which change over time. As a result, the state variables are endogenous in Markovian, and the entire history matters and cannot generally be summarized by the last round's outcome, and there is a curse of dimensionality. These problems have long been recognized, and they are a reason for why the literature on dynamic markets, financial markets, but more generally oligopolistic markets, have a focus on environments that are symmetric in some sense. Right? So we either assume that private information is Markovian and traders are symmetric, or we assume that prices are fully revealing in each round, which amounts to joint symmetry assumptions on the market information structure. Or we assume that prices are disclosed after every round, information is disclosed after every round. Or we focus on stationary equilibria, another joint symmetry assumption. Another approach in more popular empirical work has relaxed the assumptions about the state variables that players need to keep track of. So this led to the notion of the oblivious equilibrium, which is popular in computational work, and various notions of self-confirming equilibrium. So Ariel Pekis and co-authors have come up with a computational counterpart of self-confirming equilibrium. But there's a need to introduce models and techniques, possibly non-recursive ones, to model markets with dynamic trading and dynamic inference. I didn't mention the crucial point. So with these assumptions, Markovian private information metrics traders and so on, stationary equilibrium, full revelation, and so on, inference effects are essentially static. Trading decisions can be dynamic, but inference is static. Right? So if we need new methods if we want to model markets with dynamic trading and dynamic inference. And we need new methods that will help us accommodate the relevant heterogeneity. Now, incidentally, the approach to transforming a equilibrium fixed point into a fixed point in price impacts gives a solution to this problem. In fact, a recursive and a non-recursive solution. So in a couple of recent projects, joint with Jihyun and Xian, who's here, we introduced a recursive and a non-recursive approach in a supply functions model and also in a Cournot model. These methods can help us accommodate non-Markovian state variables and history dependence. interestingly, the non-recursive approach has better computational properties, and it also maps into financial market practice. It maps better into how firms do forecasting. But I'm getting ahead of myself now. All right, so let's move on. For some questions, for instance, in much empirical work, it is essential to account for the endogeneity of the market structure. Right? In a specific application, we often know enough about the market to only have to tackle a relatively simpler problem, which maps into a two-sided matching model, which we know how to work with well by now. But more generally, the problem of endogenizing the market structure defines a matching theoretic question to which a solution remains open. So if we look at the theory of matching, starting with Galen Shapley in the 60s, the theory accommodates well markets or games in which agreements, contracts, or exchanges among agents are substitutable. So roughly speaking, this means that signing a contract makes agents less likely to sign others. In a recent project with an article from Nathan Yoder, who is at the Terry Business School, we show how matching methods can actually apply to environments in which all contracts are complementary, right? So these two assumptions, substitutability and complementarity, induce a monotonicity of the fixed point operator. These are different operators in each case, which is not guaranteed otherwise. But providing general predictive results about endogenous market structures based on stability will require new ideas which can accommodate substitutable agreements alongside complementary ones. Solving this problem would also open the door for matching models to new applications, to new markets. All right, lastly, when traders are large, when markets are imperfectly competitive, allocation is never really efficient. You know, not even in dynamic markets, as long as the gains from trade are renewed through shocks to informational liquidity. So market, imperfect competition has shifted our focus from looking at efficiency in welfare analysis to how the surplus is distributed or redistributed among market participants. The need for market design to recognize values other than revenue efficiency has been embraced by models of markets which are not price-based. But in a financial market context, any type of regulation, the market structure, market design, or transparency also involves a decision about a redistribution of risk. Which traders will be exposed to which types of shocks, how the risk is going to be shared among market participants. It is a simple observation, but a study of redistributive effects of market design would really complement our understanding of how market design matters. This question also provides an opportunity for market design in practice. Imperfect competition motivates the use of the tools of market design for redistributive purposes. Now, it looks like I have a little bit more time. I mean, Bruno is the boss, and I'm happy to take questions. I have some additional research questions that I would like to mention, but unless you have more specific questions, or perhaps you would want to ask them after I go through these. Happy to take questions at any time. Whatever works. Bruno is the boss. You tell me what to do.
I think the students are the boss. If anyone has any question and wants to stop in there now, we can have some questions, but like otherwise we can let Marzena continue with her final points.
I can talk. I can talk if you want to.
Okay, so like, please continue.
All right, so let me mention a few more questions. For those of you who are, into applied theory problems, you might wonder, what about the tools of traditional mechanism design, right? Can they be useful in developing these design principles for decentralized markets? Well, as it turns out, studies of financial market design often make a case for the use of indirect mechanisms, right? So specific mechanisms such as the uniform price auction. And this is because in markets with heterogeneous traders, problems of financial market design may not be amenable to traditional mechanism design analysis via the application of the revelation principle and direct mechanisms. Roughly speaking, the reason is that types are endogenous when traders are heterogeneous, right? So the idea is to develop results that do not resort to VCG style analysis, which presumes that the designer knows a lot about the market, or presumes that the mechanisms are not budget balanced. Now, having said that, when feasible, the tools of mechanism design and perhaps information design could really complement our insights based on equilibrium analysis. And it looks like the relevant notion of implementation is going to be the posterior implementation introduced by Green and Lafont in the early 90s. Let me mention one more problem which applies market design ideas to high frequency trading. So recent studies have called attention to the rents captured by high frequency traders. I mean, the topic has been controversial to say the least. Price differentials in these markets induce latency arbitrage and competition on speed. Traders with faster technologies can be quicker in reacting to these price differentials, which allows them to capture a large fraction of the surplus, and in turn gives them incentives to invest in faster technologies, inefficiently invest in these technologies. So that's the core concern. Now, the cross-asset conditioning we talked about earlier suggests a potential market design solution to this problem, which can eliminate these incentives. So demands contingent on simultaneously determined prices allow traders to react instantaneously to any price differentials. They level the playing field for all traders, and they eliminate the rents altogether. All right, this is a laundry list, but let me go through it. I have another problem I would like to mention is privacy, which is a common concern in markets. Economists involved in practical market design often caution that the revenue and efficiency properties of designs with superior theoretical properties can be compromised if we ignore the bidder's preference for privacy. In financial markets, the preference for privacy is clear. Why do large institutional investors choose to trade in dark pools? Well, large traders do not place their orders at once. They split them into smaller blocks placed sequentially on the market in order to mitigate the adverse effects of price impact, as well as mitigate the risk of exposure. If we place a large order in a public exchange, the price will move sufficiently to signal to others that there are more orders coming in the same direction, right? So dark pools, many dark pools actually do not have their independent mechanisms for price determination. They rely on prices from public exchanges, randomized slightly. So traders choose dark pools to avoid exposure of their orders. That's the problem. Now, privacy was actually first studied in computer science. So CS developed a systematic approach to privacy based on a notion of differential privacy, which is often associated with Cynthia work. The idea is as follows. we say that a mechanism is differentially private if the presence of or a removal of a particular individual from a database we are looking at has approximately no impact on the outcome of others, right? So we wouldn't be able to infer from the data if this individual is or isn't present in the data set. But in many markets of interest to economists, participants are not negligible in trade. The participants' behavior impacts prices and allocations of items. In fact, successful design that promotes the efficient allocation of units often requires that outcomes must respond to incentives to behavior. Right? So there is a need to develop a notion of privacy that is relevant for markets with large traders. Okay, how do we design privacy-preserving mechanisms when bidders are large? So these models with price impact can be useful for that. Now, for those of you who prefer to work with data, let me just put it out there. Collecting detailed institutional data on the types of assets traded, the types of investors who trade them, and the associated details of market design and market structure would provide an immense service by introducing new stylized facts and defining a gradient for future work for all of us. And let me finish by mentioning one specific problem for which we do actually have data. This problem is related to yet another consequence of the failure of spanning, right? So that's another implication of market fragmentation as implied by the failure of spanning. We discussed how when we account for the fact that asset markets do not clear jointly, but clear independently, the introduction of securities whose payoffs are neutral to the payoff span of the traded assets is not neutral to welfare. But this further implies that portfolios of securities with the same span will not be payoff equivalent. Okay, in fact, none of them will. Okay, so this leads us to revisit the standard portfolio choice problem in a decentralized market. Taking efficiency as the objective, which securities should traders trade when trading is decentralized, in the sense that assets clear independently rather than jointly? Should they trade an index, the market portfolio, defined as a security whose weight is proportional to the average trading needs? Or they should trade multiple funds, right? Securities that hedge the same risk as the underlying assets. Per the standard contingent models recommendation, instead of trading the underlying assets, traders can equivalently trade the same or a smaller number of funds. That is a complete set of securities. More specifically, the standard model we learn in graduate school tells us the same funds are efficient for any investor class, regardless of the size, direction, or the heterogeneity in their trading needs, or the distribution of assets. Only the number of funds matters as long as they have the same span as the underlying assets. Now, these results not match the portfolio data. Portfolio holdings are heterogeneous, and they deviate significantly from the market portfolio. Typical institutional investors hold around 60 stocks. Now, it turns out that when traders have price impact, the standard portfolio choice results do not apply in a decentralized market. So once again, it's a joint implication of imperfect competition and market fragmentation. So the intuition is as follows: the efficient portfolio now does depend on the traders' heterogeneous size and direction of the trading needs, precisely because they have price impact, right? And the size and the direction of their holdings matters for how they want to balance their price impact. So specifically, the same funds for all recommendation does not hold when assets do not clear jointly. And moreover, the efficient portfolio now involves strictly more securities than what the competitive model would predict, the competitive centralized model would predict. So the intuition here is more subtle, but it has to do with balancing the within and across asset price impact. So for instance, one can show that instead of trading a market portfolio, it is strictly superior to trade assets that are closely correlated and hedging in the same direction, but aren't perfectly collinear. Now, these results, to be sure, these results are the solution to the standard optimization problem underlying portfolio choice in the standard asset pricing model. As soon as we allow that the number of traders is finite and assets clear independently rather than jointly. And these models can, these results can be directly taken to data on portfolio choice, which are now becoming available. I focus on centralized versus decentralized, but naturally markets have never really been centralized. And these results suggest that it matters. These results suggest that there's still a lot to understand. And this is a very exciting time for anybody who's interested in markets and market design. Happy to take questions or talk to you offline.
I have a question if no one has. I mean, I have several questions.
I have one question, but I go after you. You can
no,
go
first. Go, please, go.
I have a very broader question. So you shortly mentioned the restructuring of the treasury market, and I think the treasury market is partly decentralized. Do you have any opinion about this discussion that is ongoing, that the treasury market should be centrally cleared and how it should be restructured? What do you think about this discussion from Duffy, basically?
Right, Daryl Duffy made a compelling argument that we should be seriously considering redesigning the treasury markets. These unprecedented shocks during the pandemic have put a lot of pressure on the clearing mechanisms, which simply could not provide enough liquidity during the crisis. I mean, it is a fascinating point. I think it is inevitable in some sense that there will be some adjustment. You know, at the end of the day, it is always an empirical question. We need to balance the likelihood of these kinds of shocks of this magnitude hitting the system again.
Yes. With
the cost of redesigning these markets. I mean, that's not a trivial task. It is costly, it is time consuming, and even if we abstract away from political economy types of considerations, but I feel that something could be done. Some mechanisms could be introduced as a, you know, as plan B, sort of in the form of a crisis mechanism. I mean, if we develop the infrastructure for market clearing during the time of the crisis, we can still rely during the normal times. We can still rely on the traditional market clearing mechanism, but like we can be ready and slowly transition to these other more efficient mechanisms, which eventually might improve liquidity of these markets anyway.
Okay, so but it would more be like staying traditional and having some kind of crisis mode, and then maybe over the time go over to something new. But yeah,
I mean, that's one possibility. Yeah. But let's see what happens. Yeah. I mean, this problem is relevant not only for treasury market. I mean, it became so focal during the pandemic because we were all looking at the trillions of liquidity that the treasury market was trying to inject into the economy. I mean, the data was fascinating, and then Daryl and others have observed how much pressure that experiment put on the system, and that things could have been a little bit more liquid and more efficient, right? So, I mean, obviously, this question is on our minds. I mean, whether or not something happens, let's see, but it's a fascinating problem for anybody who want to structurally evaluate that market design change. I mean, the problem is out there, waiting to be evaluated.
Okay, thank you.
So I had a related question, but more theoretical than it's just so a lot of what you talk is we're focused on the investors buying the assets. How do you think where we stand in terms of design the incentives of the agents that actually design the platforms, right? Like how, because many of these like exchanges are developed by private agents, and some of them are also investors. So how you think about, like, should we think about design the incentives for these players or for the end investors? Like, how do you think about this trade-off?
A fantastic question. Thank you so much for bringing this up. Right. So of course, you know, if you let traders choose which, let's say, orders to submit, right? For concreteness, contingent or uncontingent, if you ask them, do you want to condition on more variables, they'll say yes. An individual-based response problem implies that they will want to submit contingent orders, but these decisions are not in the hands of individual investors. These decisions are in the hands of providers of these market clearing technologies, right? As you just pointed out, and these providers are motivated by private incentives, profit maximization, and so on. So does any of do any of these results hold up if we take into account the incentives of these providers? Well, so that's outside of the, you know, of the models that I've worked on. But if you endow a provider with an objective to maximize liquidity or maximize volume, even through the fees, the trading fees, then one can show that under very general conditions, the incentives of the providers are aligned with efficiency, in the sense that they wouldn't want to give the traders an opportunity to submit contingent schedules and clear all assets jointly. And the basic reason is that doing so will change liquidity and pricing back within and across exchanges that will actually reduce the volume traded. Okay, so all the incentives to introduce new products and new technologies I talked about are under very general conditions aligned with the incentives of the providers. Otherwise, we would see some enormous force towards you know, a single exchange, a giant merger. I mean, abstracting away from antitrust issues, but there are incentives to separate. There are incentives out there for there to be multiple exchanges for different assets and traders, right? So, I mean, I also talked about how the problem of the endogeneity of the market structure is still open. So even if we don't know which market structure is optimal, we know that the centralized market structure is not going to be the efficient one or the stable one under very general conditions. Traders have incentives, providers have incentives to separate themselves and offer new mechanisms to subset of traders. These forces will always be there. Really great questions. Okay. Thank you. So you're right. I tend to focus on investors, but the provider's perspective is perhaps even more relevant. It's just a professional bias to talk about efficiency. There was one other question.
I have a small question. How would collusion affect the efficiency in a decentralized market, in the setting and the environment that you just talked about?
I see. Thank you. Well, people have studied collusion in the context of auctions, also centralized markets. I don't know what the effects of collusion will be. This is another wonderful open question, and maybe we'll know in 5 or 10 years after we have enough results in different market settings. At the same time, let me tell you that I recently attended a seminar by Jean-Francois Hood, who is at the University of Wisconsin-Madison in my department. And he and his co-authors have a new paper. It's a structural paper about collusion in a decentralized market. It is a fascinating problem. I mean, the paper really made me appreciate that the collusion is a different phenomenon in a fragmented market. There are many more possibilities to collude, and accounting for market fragmentation really changes the way we should be thinking about collusion, and it will presumably change the way we evaluate collusion. So I encourage you to look at it.
Okay, thank you. I'll check it out.
Any other questions?
Okay, I forgot to mention actually. So for anybody who is interested in these or related problems or models or open questions, here are some surveys that have recently been written or published. They are mostly focused on financial markets. Some of them are also about auctions. But there are a lot of interesting questions suggested in these papers, in these surveys.
Yeah. So if there's no more questions, no? Okay. Thank you, Marzena. That was a wonderful lecture, and thank you for your time coming here, and thank you for all the students that join us. This lecture should be available on YouTube soon. I will try to post it this weekend. Thank you again for everyone.
Thank you so much. Thank you all for being here. Thank you, Bruno.
Thanks a lot.
you.
Thank you.
Thank you.